Good. So the first two questions we did on lease were having two aspects. Aspect number one, we did the leases in the books of the lessee. Then our second question was in the books of the lessor. Then the other concept was the fact that all of them were in arrears. The payment was in arrears. Arrears means they use the assets, then they make the payment after. That is the meaning of the arrears. So I want us to check a scenario whereby the lessee is making payments in advance. Advance means they are making payments at the beginning of the financial period. You know, mostly these interests are computed on annual basis. So if the amount is paid in advance, then the advance amount should not attract interest, because advance means at the start. But you see, interest is computed for the whole year. So there is a little bit how your amortization will change compared to arrears. So write for me there. Rental. This pen is misbehaving. So you say rentals. I think I need to refill my pen. Let me get a refilled pen, just a minute. So right there, rentals paid in advance. Rentals paid in advance. So when you pay in advance, the advance amount should not be subjected to interest. So even I don't have structured notes for that, just write something small. You say the finance charge stroke interest should be determined after subtracting the advance amount. That is the most important issue. So nothing much. Let's go to illustration. Handout question 3. So Maria, you can post for us the handout. You can repost it in the group. The one for leases. Then we go to question 3. The last question in that handout. The last question in that handout. So kindly repost. Maria, nimekupatia kazi yako. It was posted yesterday. So can you trace it?
Yeah, shortly.
Okay.
Yeah. Questioned.
Thank you. So please, those who have not opened, kindly open the handout. Then we go to question 3 of that handout. So we go to question 3 of that handout. Question 3 of the handout. And I read, you will allow me to read. It says, CR7 must be Cristiano Ronaldo, is a manufacturing company. A manufacturing company leased a plant from Smart Equipment Limited on a finance lease. The details of the lease agreement are as follows. Commencement, 1st January 2018. Fair value of the plant, 120 million. Expected useful life, 3 years. Annual lease payment, which is paid in advance, 50 million. Interest rate implicit in the lease, 12% per annum. Then we have lease period, 3 years. Residual value of the plant is 6 million. Show by way of extract how the above transaction will be reflected by by CR7 Limited in the following. So CR7 was the lessee in the statement of profit or loss for the year ended 31st December 2018 and 2019, then the statement of financial position for those 2 years. So now we can start. They are paying in advance. Yes, they are paying in advance. So number 1, we'll come here and say, right of use. Right of use asset is equals to 120 less work in thousands. The right of use is 120. Right of use is 120. Then there is the annual depreciation. So annual depreciation. Annual depreciation will be 120 minus residual value. You don't depreciate. Don't depreciate the residual value. Residual value, they said, is 6. Residual value is the amount you will recover. From this 120, you will recover the 6 million. So you subtract, then you divide by the useful life, which is 3 years. So how much is the depreciation charge per year? Somebody there can give me the answer. $38,000. Thank you. Then now we go to amortization. So you say amortization. Amortization schedule. In fact, I want to squeeze it up there. I hope you have done that. So I want us to carry out amortization. So amortization schedule. Amortization schedule. So you'll say here, they started in 2018, and it was for 3 years. So it will go up to 2020. So have that. It will go up to 2020. Then you will have balance brought down. So if the payment, please, I need your attention there. If the payment was being made in arrears, then interest, the finance charge will come at this stage, the finance charge, because you charge it on the opening balance for the whole year. But in this case, they are making payments in advance. So once someone has paid in advance, the advance amount will not attract interest. So you subtract first the advance, then the remaining balance is what you subject to interest. So you come here and say, rental paid. So of course they are paying in advance. They are paying in advance. So if they are paying in advance, then rental comes before interest. So the amount which will remain, in fact, I can bring it here. You can call it principal balance. Though some students will not do this, they will just take this minus this, then whatever remains they charge interest. But for clarity, let's bring here the principal balance. So the balance which remains at the beginning of the year is the one which will attract interest. So call it finance charge. They have said 12%. 12%. Then we shall get the balance carried down. Get the balance carried down. Then to the far end, I want to fix. We are in the books of the lessee. So I want to bring non-current liability and the current liabilities at the far end. Please capture that. Rental, they are paying in advance. Maria, not clear. Maybe the last two. Then you check our amortization. Hizo zingine. Hapa mwisho tunaweka non-current liability and current. Non-current liability and current liability, the last two. This is balance carried down. This is the finance charge. Yeah, I'm trying to squeeze, but itabidi mfuate na mimi, msikuache nyuma. So Miriam, you have seen that. So the advance payment is 50. Advance means they are paying at the beginning of every year. So the opening is the 120. So when they started the year, the agreed amount was 120. Then immediately, those people paid 50. So the balance which will attract interest for the year is 70. So this is what I was saying. So this 70 is what you multiply by 12%. because now that is what will attract interest. So I would want you to check how they differ. When you are paying in arrears and in advance, must you confuse those two? When you are paying in arrears, then here hatungekuwa na rental paid here. Ungekuwa hapa na finance charge straight, because you are supposed to charge the opening balance. But yes, this is in the books of the lessee, Joshua. We're in the books of the lessee. But if at all they are paying in advance, like in this case, then reduce the balance first before you charge the interest. So what is 12% of 70? Give me that figure. Thank you. 84. Meaning the closing balance will be this plus this. Will be 78,400. Good. That one becomes the opening, 78,400. So ukifungua mwaka 78,400, alafu wao wanaleta pesa immediately. So the remaining balance will be 28,400. 78 minus the 50, 28,400. Times 12%, what will you get? What do you get when you multiply? $3,408. So the closing balance will be, you add the principal balance, which is 28,400 plus interest, 3,408, 31,808. So that will be the opening, 31,808. So here there is nil, there is nothing remaining. Because the opening is 31,808, they're expected to pay 50. So there will even be an overpayment. So there is no principal balance. So my main issue was just here. When you are making those payments in advance, there is how the schedule changes. All right. So I want us now to come up with the liability parts. So liability, if at all you never captured it from the other questions. At the end of 2018, the total liability is 78. When you have a liability, try to portion it into two, the long term and the short term. Long term and short term. So long term is the non-current, the one which will not be paid in the next 1 year. So when you check ahead, in 2018, you check ahead. What will remain unpaid by the year 2019 is long term in 2018, because it will not be paid in the next 1 year. So out of 78, what will remain at the end of the next 1 year is 31. So bring here 31,808. I'm sorry that for maybe too small, but if at all we are together, you will be able to see. So the difference between 78,400 and 31,808, that one will be paid in the next 1 year. Because out of 78, what will remain is 31. So it means the difference will be captured in the next 1 year. How much? That is what we bring as current. Current is short term. So how much is that? How much will that be? How much will that be? 46,592. So record there, 46,592. 46,592. 46,592. Thank you. Let us go to 2019. Let's go to 2019. 2019, the total outstanding is 31. When you check the next 1 year, there will be nothing. So there is nothing, meaning this amount must be paid. There is nothing which will be outstanding. So this is 31,808. All of it must be paid because there is no long term if you check ahead. So here there is nothing, there is nothing. Correct. Have that. So the examiner wanted the financial statement extract for these 2 years, 2018 and 2019. So you say here, CR7 Limited. This is the lessee, Joshua. E&L extracts. Only for these 2 years. Only for the 2 years. 2 years is 2018 and 2019. Good. So we start. Lessee, we are in the books of the lessee. So lessee talks of expenses. So the expenses which the lessee is talking about, 1, depreciation. There was annual depreciation of 38. You gave me that figure. So every year, depreciation is an expense, so you don't accumulate. Accumulation of depreciation is in the balance sheet, not in the P&L. Then we have finance charge. This finance charge, you treat them as expenses. So we have finance charge. So finance charge, we have 84. We have 34,08. So this is 46,400. This is 41,408. So complete that. That is the extract. Let's go to the balance sheet unless you have a question. That. So we want to check the balance sheet. All right, so you start by saying non-current assets. Non-current assets, the list assets, you recognize it in the books, but you recognize the rights of use. So you say right of use assets. Right of use assets, ROU. That is what you recognize, which was 120. So you bring 120, you bring 120. You less accumulated depreciation. So less accumulated depreciation. Depreciation was 38 per year. So year one, you will bring the 38. Year two, you accumulate 38 plus 38, 76. Like that. So (120) minus 38, 82. 120 minus 76, 44. Like that. So have that. Then let's go to liabilities. We have non-current, lease, obligation. Don't have enough space. Non-current lease obligation, and there is current. Current lease obligation. Those two. Long term and short term. Have those two. So long term, 2019 is this one here. So we pick them. That's why we extended this table. 31,808. Short term is 46,592. Total 78,400. Then in 2019, long term there is nothing. 31,808. 31,808. So complete that. Please once you are done, get out your past papers. There's a question I'm looking for. The problem I can't recall which sitting. There is one question in your past paper. Just give me a few minutes to look for it. Get out your past papers. Yes. I'm looking for the question, so just hold on with me. I know there's a question, but I can't recall which sitting was this. Just give me 1 minute. Okay, go ahead. I'm very sure there is one question here. I think I got it. Yeah, in the back. So this is going to be August 2022. August 2022. Question number 4. Please someone to tell us the tape. My paper is not compatible with the one you have. Which page, somebody? Whoever has gotten August 2022? Page 24, as per usual. So please check page 24. Let everyone be there. So allow me to read. This is August 2022, question 4A, page 24. So allow me to read the question. It says, the question says, on 1st January 2019, Mohamed, nani wewe umeweka kwa screen? Mohamed, kuna mtu umeweka kwa screen. Who is that? Can that really be a member of this class? Amukar Mohammed. Who is that on the screen? So on 1st of January 2019, Breakwood Limited entered into a contract to lease item of plant and equipment from a supplier for a 3-year period. The terms of the lease were that Breakwood Limited was to pay shillings 500,000 each year, with the payment commencing on 31st December 2019. Initial cost incurred on the lease amounted to 30,000 and were paid by Breakwood Limited. The plant and equipment had a remaining economic useful life of 5 years at the inception of the lease. The lease contract did not contain any purchase option for the lessee. Breakwood Limited can borrow at a rate of 10% per year. Required, analyze the accounting treatment of the above lease transaction from the inception and for the 3-year period of the lease contract, 10 months. So at the inception and throughout the lease period. So I know, I know how we normally go with students. When I'm reading, inaona kama history. So can you read it alone once more, pitia tena, so that tutafanya kitu tumeelewa. Go through that question alone. Kila mtu amesoma hiyo swali, and I hope you have understood what you have read. So these people, one, they have not given us the current fair value. They have not given us the current fair value of these lease assets. So when you have not been given the fair value, unajua kuna mtu atafanya hivi, anasema tu 500. How many years? They entered into contract, plant and equipment for supplier for a 3-year period. So there is somebody here atachukua hiyo 500 times the lease period 3. Aseme the value is 1.5. You know, the 500 is what they will be paying. So you cannot consider 500 to be the you cannot say the 500 is the right of use. No. 500 is the rentals. That is the installment. So to get the total value, you will also not say just 500 times 3. You will do what is called discounting. You discount. So to get the value of the lease, you know where you have not been given the fair value. You know the questions, but then you need to know this. For lease, where you have not been given the fair value, and you have only been given the installments, you discount. You determine the present value. So the present value becomes the value of the asset. Because you see this 5, we are paying 5 in future. So you have to determine the value for money. So let's have here. You say value of the assets. Of the assets is equals to the present value of the annual installments. Correct. Have that. So to get the value of that asset, you discount the annual installment. So you say here 2019, three years. Then cash flow. So cash flow constant 500. Then interest factor is 10%. So interest factor is 10%. So 10%, we will have here 1 plus r raised to power negative n. Those who have done FM, you know. We take 1 plus r raised to power negative n. So r is the 10%. So 1 plus 10% is 1.1. So it will be 1.1 negative 1, 1.1 negative 2, 1.1 negative 3. Like that. So what you get here is the present value. So I want you to discount for me. Take 500 times that, people, then give me the total. I will only be interested in the totals. Let's round off to whole figures. If you get a decimal, round off. So 500,000 times 1.1 negative 1. So start with this is when you multiply. Then it gives you the total. I'm waiting for the total, please. Hello. Hello. If you can manage big, fine. Like 150. 150. So someone with the total, oh, I'm waiting for the total. I'm waiting for the total. Who has the total? Others in a calculator. So I will fully rely on your answers. I'm waiting for the answer, please. Don't close this. I know you have the answer, lakini mnangoja mtu aseme. Haya, so Maria amesema kwani iko nini? Umesema 1243, 425. Someone to confirm? Yes, now it has been confirmed. Huh? 1243, 42, 1243, 425. 1243, 40. Maria, hebu angalia decimal hapo. Kinley. Kidogo tu, Brian. Jacinta. 1243, 426. This is here, cash flow factor at 10%. 10% is the 1 plus RS per negative n, then the present values. So people have confirmed 1243, 1243, 426. Then we are being told in the second wait first. I want to confirm, by the way, you know, this is an annuity. So I want to check if we can get the same answer. So you say or you can take the installment times 1 minus 1 plus r raised to power negative n. Yes, you can still do it that way. If you don't want to go the long process, you can use this formula because the cash flows are the same. To get the present value of constant cash flows, you can still use this formula. So this will be 500. Just confirm to me if we are getting the same times 1 minus 1.1 raised to power negative 3. Can you confirm whether it will give you the same answer? Confirm whether you will have the same answer. It should. If we are accurate, it should be the same. But confirm. Someone has confirmed? Oh, sorry. Divide by R. So whatever you get here, you divide by 0.1, the 10%. You divide by R. So whatever you get, you divide by 0.1, which is 10%. Can you confirm, please? Confirm. Somebody to confirm. Kwa nini mmekuwa slow leo? Na hii discounting inafanyanga FM sana. You take 1.1 raised to negative 3, then you say 1 minus the answer. Whatever you get after raising to negative 3, you say 1 minus the answer. Divide by 0.1, then multiply by 500. Jen is saying yes. Someone else getting the same? Just one confirmation. You sure have confirmed. So which one is better? The first or the second? Would you prefer the first one or the second one? Which one will you prefer? Jacinta will go for the, not Jacinta, Jen. Jen will go for the second one. Brian, wewe utachukua gani? Linda umenyamaza sana. Maria, you will go for the first, second. Bas, kila mtu ako na yake. So wewe chukua yenye inakufurahisha. Take the one which makes you happy. Sawa. So it means these people, when they tell you to pay 500, 500, 500, this 500 is based on this principal amount. This one here. So in the question, actually, I want the concept to come home. The concept is where you have not been given the fair value of that asset, instead you are being given what they're supposed to pay, then you discount to present value. So where fair value is not there, you go for the present value. So present value, you discount the annual installments. That is the concept I want. So this is the lease liability. This is the lease liability. But the examiner is saying in paragraph 2, initial direct costs incurred on the lease amounted to 30 and were paid by Breakwood. So this Breakwood, incurred another cost of 30. So you will add. So add direct costs. Direct costs. Because this is the liability they are supposed to pay. Also, wameongezwa, wale incur another cost to get to in the contract, maybe lawyer or someone. For 30. So the total, you know, they entered in the lease, the value of the asset is 1243, but already they have incurred 30. So the total cost incurred in this lease will be, so this will be the rights of use. Right of use assets will be 1273, 426. Correct. So where the lessee incurs some costs, then that cost you add as part of the liability in order to get the total value of that asset. So the examiner said we show the accounting entries from the inception. So at inception, you will debit right of use asset 1273, 426. Then you credit lease obligation 1243, 426. That is the liability they have. This is the liability they are going to pay because they have already paid 30. So 30 is also credit. So you credit the cash book. They have already incurred a cost. They have incurred a cost of 30. So that is the journal entries at the start. So at inception, that is the accounting entries. When you pay, you need to credit the cash book. So credit cash book with 30. This is obligation, you also credit, then you debit the right of use, which is an asset there. So from there, we are going direct to amortization. We are going direct to amortization. So in the amortization, remember this one is in arrears. How are they paying the 500? Commencing 31st December. They entered in the lease in January, but payment is in December, so that is arrears. So the value which you are going to amortize is this one here. We are not going to amortize the 73. We are going to amortize the 43 because amortization means you are paying the liabilities. If you amortize 73, you are wrong because this 30 is a cost which was incurred immediately when they were entering into the contract. So that has already been incurred and it has been paid. So what you amortize is the lease obligation, which is 1243. This is what is going in the amortization schedule. Take note of this question. So right there, amortization schedule. So let's go. Something I've not mentioned, sensitive. The useful life of this asset, ukisoma hapo ndani, was 5 years. Ukiangalia vizuri, it was 5. Lease period was 3 years. So with us, in the books of the lessee, we are not concerned with the 5. Your 5 assets that we don't want to know. So in the books of the lessee, even amortization, you only amortize for the lease period, which is 3 years. Even depreciation, depreciation will be the total value of the asset, which is the right of use. We depreciate the right of use. So 12,473, 426 divided by 3 years. So where there is a difference between the useful life and lease period, in the books of the lessee, we move up to the lease period, not useful life. After lease period, we return the asset. So we are interested up to the lease period. So how much? This value divided by the 3 years for me to get depreciation. Give me the answer. Thank you. 424, 475. That is the depreciation. Thank you. Let's go to amortization. So amortization schedule. So right here. So year 2019 to 2021. 3 years. 3 years. Very good. Then now you will talk of balance brought down. You talk of the balance brought down. Finance charge. Where the payment is not in advance, you bring the finance charge first. So finance charge is the interest, which is 10%. Interest, which is 10%. Then you give us rental. Rental paid. You give us the balance carried down. Breakwood are the lessee. So you talk of liability. Like that. These last two are our own creation. These last two. But they're also very important. They save time. So student mwenye kuja class, Yeah, akienda kwa mtihani aone 500 for 3 years. Anachukua hiyo 500 times 3. Anasema the value of the asset is 1.5. That is wrong. These amounts are being paid in future. So you discount them to present. But if you have the fair value of the asset, then that is the value of the asset, no problem. That one you have noted. So rental, you are paying 500. So you will subtract like that. Subtract it like that. So balance brought down, we discount the obligation, not the right of use. You know, the right of use includes the cost, the direct cost, but direct cost has already been paid. So you amortize the liability, the 1243. Kindly take that into account. So this is 1243, 426. 10%, because of those rounding offs, let's just round off to whole numbers. So if you round off whole number, this will be 1243, 43. Yeah. So balance carried down, avoid wasting time. You will allow me to calculate, then you confirm if I'm wrong somewhere for correction. Kidogo. So this is 1243, 426 plus 1243, 43 minus 500. 867, 769. 867, 769 times 10 will be 867, 77. Yes. So plus 86, 777 minus 5. 454, 546, 454, 546, 45455. Yes. Copy at your own risk. So plus 45455. 500 because of rounding. Yeah, that is nil. It comes to 0. Comes to 0. I hope because we had a 0, so that is, I think we took 1 because of rounding off, so that is okay. So ufike hapo, then we derive this to this and this. Then we do financial statements, then we are done with that question. Nataka muangalie hiyo swali na macho 2, 3, 2, 3. Wanaweza tumia because of that concept, this one here. They don't give you, they fail to give you the fair value of the asset, but they give you installments. So they give you installment, you don't multiply by the number of years. You determine the present value. And if they incur direct cost, you add. That is now the right of use. But amortization is based on the liability. I try to believe that all of you are there. So let's bring the liability part. So liability, 2019, this is the total. This one will remain by the next 1 year. So this one comes here, 454, 546. So this minus this becomes current. So 867, 769 minus 454, 546. 413, 223. There. So fill in that one. Good. 2020, this is the balance, nothing ahead. So there is no long term. So the whole amount must be paid. 454, 546. There is nothing, there is nothing. So what was the question? So they want, so let's come up with P and L. So P and L extracts. Well, we have to say those books. Breakwood. So we are in the books of Breakwood. Breakwood is a lessee. So Breakwood Limited, P&L extracts. Yeah, that is more sensible. So 2019, 2020, 2021. So you will talk of depreciation, the annual depreciation, So annual depreciation, we calculated this one here, 424, 475, 424, 475, 424, 475. So depreciation is constant throughout. Depreciation is constant throughout. Then you bring the finance charge. Finance charge, just pick them in this column here. So this is 124, 343, 86, 777, 45, 455. If you want to add, this is an extract, so up to there is enough, but if you want to add, please add and then we proceed. Thank you. I hope that is done for those people who are doing the addition. So just randomly, I will just ask randomly whether someone is done, so that Marian, Ibrahim, are you done with this section? Because I want to delete it, I come up with the balance sheet. You can confirm. When you confirm, I'll assume we are all done. Marian, are you done with this section? Marian, Ibrahim. I'm not typing is hard. You can get me restrict again. So I pick someone else. Wakio, are you done with the P&L? You can confirm. Okay, so let me assume everyone they are done. So let's go to the balance sheet. Let us go to the balance sheet. Extracts. So again, Brainwood. Statement of financial position. Extracts. Hazards. It is 31st December. So 30. Wait, just a minute. There's a question somebody can ask, should be asking, or somebody can ask you. Now, by the way, somebody can ask you that in my own small thinking, and I'm in the small thinking, rent is an expense. So when these people pay rent, why don't you bring rent as part of expenses? That's a question you can be asked. Why are you not bringing the rent as an expense? And in the books of the lessor, why are you not bringing the rental income? The rental income as an income. Instead, we are only concentrating on the finance income and the finance charge. Why are we not capturing this rental? The reason why we are not capturing that rental, according to IFRS 16, lease is like a special loan. Lease is a financing device. Inakonga loan, become a loan special, you know, umepewa kazi ya kubeba vitu zingine na una gari. Naweza kuja kwako unipatie gari. I do that business. So inakwanga in form of a loan, then I start paying you. So rental paid in quotes is like a loan repayment. It is a loan repayment because this balance brought down is a loan value. So when you pay the loan paid is not expense. Ukiallow watu ni wakilipa loan wana expense. Utajua kuna mtu ataikuwa na profit in this country because profit will be the driver of tax. So when you pay loan, you don't expense that amount. What you're allowed to expense is the interest part. So lease is a special loan, and therefore the amount we pay, the installment we pay, should not be treated as an expense. What you need to recognize out of that installment is the interest part. You know, this 500 inalipia mpaka interest. Inalipa interest kwanza, actually interest yote, and part of this balance here. So finance charge is what you recognize, but not the loan repayment. It just came up in my mind. So 2019, 2020, 2021. Yeah. So you'll come here and say, non-current assets, rights of use assets. Right of use asset, remember we calculated the value, check. It came to 1273,426. Please just check the right of use. I believe it came to that, yes. 1273,426. 1273, 426. But there was the accumulated depreciation. So you less accumulated depreciation so that you can get the net book value of the assets. So you less the accumulated depreciation. So depreciation was, annual depreciation was 424, 475. You subtract. So this is 424, 475 times 2, 848, 950, then plus 424, 475. So that one comes to 1273, 425, which I think it was just a rounding off error there. There was one difference there. Therefore, the net book value, that is nil. So 1273, 426 minus 424, 475, 848, 951, then 1273, 426 minus 848, 950, 424, 476. Something like that. Finish that before we wind up with the liabilities. Yeah, you are done. So liabilities. So liabilities, you'll check the non-current. Lease, obligation, and current. Current, lease, obligation. So non-current 2019, everything is here. Just pick them. 454, 546. This other one, 413, 223. That one should give you 867, 769. Na mtu asiulize kwa nini haibalance na hii ya assets. It is just an extract. It is not a complete. Ona hatuna capital, hatuna equity. So it's just an extract. Extract means give us the small portion you can see. Then this other one, there is nothing. So 454, 546. We are done with that balance sheet. So have that extract with you. Finish it up. So Maria is requesting 10 marks itatoka wapi? Maria, ni kidogo ama the workings ni kidogo ama ni mingi? Maria, workings ni kidogo ama ni mingi? So that I can tell you how 10 works inakuja hapo. Nimeona 10 nikafikiria tu unaniambia 10 minutes break. Kumbe unasema well, 10 marks inatoka hapa. Check you see where we discounted, where we got this figure, the 1273, no, not 1243, this one here. Pale kwa discounting, where you got 1243 for discounting, hapo kuna one tick. Getting the right of use, adding the 30 to that 1243, that is another one tick. Something else we should give you another tick is P&L. P&L, they will mark all those expenses for the years, all of them. Then here they will mark the net book value 1, 2, 3, 4, 5, 6. Then P&L, we had how many entries? 1, 2, 3, 4, 5, 6. Also we had 6. Then this one 1, 2. So total of 6 plus 6, 12 plus 2, 14. We have 14 entries. Examiner will say any 10. Any 10 out of the 14. But examiner, ukifanya tu hivi atakutafutia tu vitu huku ndani. What they normally don't mark is this amortization. Because all the items being marked in P&L and the balance sheet, they are coming from here. So this one normally is not marked. They come and mark it here. So out of the 14 correct entries, the examiner will give you 10. So what we're going to send away over to Sao. So Maria, that is it. I can assure you, deep down my heart, hakuna mtu atakuchallenge na swali. Inaomba swali yoyote ama swali chochote ama swali lolote, whichever. In this accounting, apart from what we have done, this is the most comprehensive question of this, and it's one of the questions I want you to be checking more often, because I know students never perform very well in this question. So just keep on revising it so many times to understand the concept behind it. They will repeat it one day. Yeah, so I will end this at that stage. I will end this at that stage. And I'm introducing a new topic. So take 5 minutes break. You can stretch up the dog. Let's meet at 7:46. 7:46. Take a small break. We have relaxed enough. We have relaxed enough. There are notes I've shared with you. There are notes I've shared, and I will want us to go through them. So, presentation of financial statements. Presentation of financial statements under IPSAS. What is IPSAS in full? Let's go to the notes. May I answer? IPSAS stands for International Public Sector Accounting Standards. That is the meaning of IPSAS in full. IPSAS are standards which are normally applied in public sector accounting. In private sector or commercial sector entities, we normally use these standards. We use the International Accounting Standards or International Financial Reporting Standards. So for commercial entities which are in profit making, we normally apply these two. Public sector are not in profit making, and therefore we apply IPSAS. That is what you need to know. So let's check the definition of IPSAS. These are standards developed by the International Public Sector Accounting Standards Board. International Public Sector Accounting Standards Board, known as the IPSAS, International Accounting Standards Board, to govern the preparation and presentation of financial statements in public sector and similar bodies. IPSAS is based on accruals accounting concept, which requires that income and expenses should be recognized when they arise, but not necessarily when cash has been received or paid. So IPSAS focuses on what we call accruals. It eliminates the cash accounting. Cash accounting is an accounting whereby you only recognize income or expenses when the amount has been paid. That is not what IPSAS require. IPSAS require that income is recognized when earned, expenses is recognized when incurred, not when money has been received or money is paid. Immediately you incur, you record. Immediately you earn, you record. You know, earning does not mean you have received. Like right now, today's 21st. Some people are yet to receive their salaries. You have already earned the salary because you have worked, but you have not yet received. So right now, for those people who do budgets, you need to recognize that salary. I'm expecting salary of this, and this should be my budget. So if you're budgeting with what you have not received, it means you are recognizing it because you have earned it. So that is what the IPSAS is focusing on. It replaces the cash accounting in public sector, which I've said. So what are some of the benefits of IPSAS? Benefits. It promotes best accounting policies in accounting sector. In the accounting sector, the keyword is it promotes accounting policies. Adoption of IPSAS enhances the reputation of a public sector entity. So the reputation, you know, even in Kenya, right now, people are using the IPSAS as a template. There are templates which you have to comply with in order to comply with the provisions of IPSAS. So when a public sector entity prepares the financial statements in relation to these standards, then they are seen to be reputable. Then it leads to acceptability of accounts by the donors. Tusijidanganye, we know very well, we normally rely on donors, IMF, World Bank, name them. So when you prepare your books in accordance with the standards, then those donors will at least accept your books. It improves comparability and consistency in preparation and presentation of different government agencies. So comparability and consistency, because if this is a public school adopting IPSAS, another public school, so comparability becomes quite easy. Then it enhances transparency and accountability. Those are okay. So I want you to unmute Who is this who can unmute for us? Last it was Brian. So Jen, can you unmute? Then you read for me. Read for me this question. May 2021, question 1C. May 2021, question 1C. Jen, I've allowed you to unmute. So once you get the question, can you read?
Discuss 4 challenges facing the adoption of IPSAS in your country.
Straight hivyo, hata kuna story.
No? Oh, International Public Sector Accounting Standards, IPSAS, prescribe the accounting treatment of various items of revenue, expenditure, asset, and liabilities in the books of public sector entities. Required, with reference to the above statement. I read all of them.
Yes.
With reference to the above statement, describe 3 constraints that affect the relevance and reliability of financial information presented by public entities.
The constraints, okay. Then 2.
Summarize the key provisions of IPSAS 3 accounting policy, change in accounting estimates and errors with regard to changes in accounting policies.
But there was this one of challenges in adopting IPSAS. Was it there?
Yeah, C. Discuss 4 challenges facing the adoption of IPSAS in your country.
Yes, so challenges, please because what if your country has no challenge? What do you say? So you just guess for those people who are having challenges. That is now. So 1, back to our notes, the challenges which countries normally face as a result of adopting IPSAS. 1, there is lack of proper conceptual framework. Hiyo kitu ilisumbua Wakenya kutrain hiyo kitu across, because you know it is used by public hospitals, by public schools, by parastatals. So it was hectic to come up with the framework on how it will be adopted is always a challenge. There is budgetary constraints on implementation. It requires a lot of funds. Resistance to change by public employees. Hata unawaita training hawaendi. Hiyo kitu inakuja kufanya kitu hataki. You know this is a system. People are always anti-system. That one you know. IPSAS borrows heavily from IFRS, which tends to be complex in nature. IFRS ni ngumu. Na IPSAS, imagine IPSAS ina borrow kutoka kitu kwa kitu ngumu. So it becomes very difficult. IPSAS may require interpretation since they are only designed in English. Yes. So all the countries are required to comply with IPSAS, by the way. That's what the board requires. But some IPSAS are designed, you know, they are in UK. If this board is in UK, they design them in English, they want to take them to Congo, Zaire, where people speak only French. So they require interpretation. Then constraints that affect the relevance and reliability of financial statements in public sector. There is what we call timeliness. The financial statement loses the relevance and reliability when it is time barred. We are like a bad layer, BAD. That is not the bad I wanted. Bad barred. When information is time barred, then it loses the characteristic of relevance and reliability. Then there is always a constraint between balance between benefits and costs. Preparation costs should not outweigh the benefits gotten from the preparation of the financial statements. So sometimes you find the cost of preparing the financial statement is huge than even the benefits you are getting from those books. So that is a constraint on relevance and reliability. How will it be relevant if the cost of preparation is even? So there is always that concept between how to balance between the benefits and costs. Then balance between quantitative characteristics. The conflicts between characteristics make the financial statements irrelevant. Some characteristics normally conflict each other, hence affecting the relevancy. Here was just by the way. So we go down there. IPSAS 1. Now, the IPSAS iko mingi, but most of them are similar to IFRS, which we are doing here. So that one is not going to be my main concern. That is not going to be my main concern. Our main concern are on two IPSAS. There are two IPSAS of concern. There are two IPSAS of concern. There are two IPSAS of concern. We have, so we are going to focus majorly on two IPSAS. Those other IPSAS are more or less the same with IFRS, which we are doing here. So the IPSAS of concern is IPSAS number 1, and we are going to check IPSAS number 2. Sorry, number 24, not number 2. IPSAS number 24. Those are the IPSAS of concern in financial reporting and analysis. So IPSAS 1 is on how to prepare financial statements. How to prepare financial statements in public sector entities. Remember, for commercial, we prepare P&L and the balance sheet. What about the public sector entities? This one here, IPSAS 24, deals with the budgets. So there we check the budgeting analysis, while IPSAS 1 deals with the presentation of financial statements. So I want us to start with IPSAS 1, and God willing, I need to finish IPSAS 1 today with at least 2 questions for IPSAS 1. So go to the notes. IPSAS 1, presentation of financial statements. It guides the preparation of financial statements in public sector entities. They are required to prepare the following financial accounts: the statement of financial performance, which is the income statement, and statement of financial position, which is the balance sheet. So in public sector, when you are told by the examiner to prepare statement of financial performance, in quotes, that is P&L. In public sector, we call it statement of financial performance. We don't talk of profit or loss. They are not in profit making. So they talk of the statement of financial performance. Kuna maneno ingine. Get out your past papers. We are doing 2 questions there. So get out your past papers. September 2015, pilot paper. September 2015. Question 5. Who gets it to tell us the page? Mine is quite different with yours. Question 5B. Page 120, 101. So which is which? Me, I hope kila mtu amepata. So allow me to read. It says, the following information was extracted from the books of Ministry of Tourism for the fiscal year ended 30th June 2015. Mostly public sector, they don't talk of financial year, they talk of fiscal year. So here is the way to see it really summer. It goes straight to required. So we cannot read those things. Required Roman 1, statement of financial performance for the year ended 30th June 2015. So financial performance is the quotes P&L, then statement of financial position, balance sheet. So let's start. So Ministry of Tourism. All right, so let's work in thousands. So here you just write income. You write income, top down, anything which is coming in to the ministry, that one you just recognize as income without any problem. So accumulated funds is like capital for them. Cash and cash equivalent, no. Receivable, no. Inventory, no. Transfer from exchequer, yes. Exchequer feeds the ministry. So from exchequer, we have 1875. Then fees, fine, and licenses. Whatever fees ni expense, government you wanna charge what, so that is an income to them. So fees, fines, and licenses. 375. Then we have liability, no. Long-term, no. Finance cost, no. Supplies, no. Wages, no. Other, no. Transfers from other ministries. So from other ministries. So from other ministries, 37,500. 37,500. Transfer to other ministries, computer, vehicles, land, revenue from exchange transactions. From exchange transactions. From exchange transactions, 75. Other revenue. Other revenue, 450. Payables, no. Reserve, no. Nothing. Can you give me the total income? Adam, give me the total, please. Thank you. I can see people giving me 2, 8, 12. 2, 8, 12, 500. Expenditure. Expenditure, we take them. I'm seeing finance costs. So there is finance cost. Finance cost is 75. We are seeing supplies and consumables used. So consumables, 300. Wages and salaries. Wages and salaries, we are seeing 750. Other expenses. $900. Transfers to other ministries. $375. Only. If there is something you are seeing and you feel I've left, you let me know. Can you add? Give me the total expenses. People are giving 2.4. You subtract. So here, this one is, they don't talk of profit. Instead of profit, they talk of surplus. If it is negative, they talk of a deficit, not loss. So this is a surplus. So surplus of how much? This minus that, what do you get? We are getting a surplus of how much? $412,500. So we are done with that. I know Maria is almost asking me, where are the 8 marks coming from? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Any 8 at 1. There are 10. If you get 8 ticks, you get the 8 marks. Unless someone has a question, let's prepare the statement of financial position. We have that. We kick off non-current assets. So non-current, I'm seeing somewhere, footer, kuna land and buildings. There is land and buildings. I'm seeing 26, 25. 26, 25. Vehicles. $175. Computer equipment. So computer equipment, 200. Only. How much? $3 million. Current asset. So current assets, cash and cash equivalents, Cash and cash equivalents, 375. Receivables. 150. Inventory of consumables, 75. Add. What do you get for the current assets? How much? How much? How much is the figure? 600. So bring it here. Bring it there. Government, they work on what we call net assets. So you less current liabilities. So you less the current liabilities from current assets. They normally work on net assets. For current liabilities, I'm seeing payables only. For payables only, 375. That one will give you 275. Therefore, total net assets, total net assets is 3275. Thank you. Then, in government, we don't talk of equity. Who are the shareholders? So
Only-
you talk, Brian?
Hapo 600 minus 375 itakuwaje tu? So I think 225.
Oh, 225, eh? Thank you. So, thank you. That one. So I was saying, thank you for that. Joshua captured as well. So you don't talk of equity and liabilities, you say financed by. How did they finance their assets? So financed by. You don't say equity. There are no shareholders there. Shareholders. So you talk of accumulated funds. How did they finance their total assets? Accumulated. So there is accumulated funds, which is the first one up there. 562. 500. Then you add surplus. You add surplus for the year. So surplus for the year is the one we got here. 412,500. You proceed. I'm out of space. So you proceed. There is liability for long-term benefits. You know you finance through liabilities because I will leave you working. So you get the money to finance your assets. So liability for long-term benefits is 150. Long-term borrowing. Long-term borrowing, 750. And we are done. There is nothing. Can you confirm whether it is balancing with our total assets? Please confirm. It is in order. Oh, there were reserves. Jen, yes, reserve is part of financing. Uko chini walipisha. There were reserves. Uko chini. How much? Of where? Where are my reserves? 1350. Thank you. They had some reserves. So can you adjust? Then you tell me whether it is balancing with your total net assets. Balanced. Thank you. So that is 3225. I've seen one question which we are not doing. I'm just showing you what to do. November 2015. Iko hapo mbele, si nyuma. Iko mbele ya hiyo. Even somehow the next page there. November 2015. November 2015. Question 4B. Hapo tu mbele, haiko bali. Inajiita Ministry of what? Ministry of Commerce and Industrialization. Please check on that. Hi, you have read that question. You have read that question. So in that question, we were only being asked of the statement of financial position. Though kuna story mingi hapo, there are a lot of elements. So in such kind of a situation, students, what you do, you only pick the elements of the balance sheet, then leave alone the statement of financial performance, the P&L, leave it alone. So what you will be missing, so bring everything. What you will be missing, you will be missing this one here, the surplus or deficit maybe. The surplus is what you will not be having. But because you will be having the total net assets, take the total net assets, subtract all this to get your surplus. I hope you know what I'm saying. They only want the balance sheets. So do all the presentation, use that one as the balancing figure. There's some, I've shared with you the solution, so open. There is 4 pages I've shared in the group. Just open, I show you what I'm talking about. Just open it up. There is no need for us to waste time there. There are things ahead. So when you open it, these dogs are making noise, just a minute. Who is there? Juma? So when you check it clearly, what I'm telling you, just do your presentation of the balance sheet, everything. What you will lack is this. In exam, we're fixing your kid. But in class, like this student, alifanya statement of financial performance after fixing this amount, alifanya the statement of financial performance to prove whether what was fixed is correct. But you see now in exam, the marks allocated are so many. So you doing statement of financial performance, you'll be wasting time because that entry will only be 1 tick. And already you have maximum ticks required. So don't confirm in exam. So in that question, you will do it, fix, then check how the student did statement of financial performance to get surplus. So that one was just for confirmation purposes. Otherwise, it was not required. So don't waste your time with something which is not required. What for? So you ignore that one there. I want to take the remaining minutes. We have like 20 minutes. I know you're tired. To pass through IPSAS 24. IPSAS tunamaliza saa hii. So that I take you through IPSAS 24. We are not doing any computation here. IPSAS 24 budget is easy. I know what we need to waste time on. So I'll just show you how it operates, then mwende muifanye vizuri. So let's go through IPSAS 24. The standard requires a comparison of budgeted amount and actual amounts arising from execution of the budget to be included in the financial statements of an entity. The standard also requires a report on the variances arising from the budgeted amounts and the actual amounts. That is true. We normally do budgets. You can surpass the budget or you can spend below the budget. You can receive more, you can receive less. In weddings, people budget. We say that this wedding, this is the amount we want to use. Then you start looking for those funds by even inviting us to the group. So you invite us to the group, your budget was 500,000. We are generous. We have contributed for you 700. You have surpassed the receipts. Then you are budgeted for 5, you received 3. You have received less than what you are. So those comparison of the budgeted and the actual, and two-way, budgeted expenditure and budgeted receipts. So it's not one way only. Unajua watu wanaangalianga budget in terms of expenditure peke yake. We can budget for receipts. We can also budget for expenditure. How much did you expect to receive? How much did you receive? So it's just comparison. Then you report on the variances. Variances can either be adverse or favorable. Favorable is a positive variance. Adverse is a negative variance. So there is, in your first paper, I realized, hakuna swali, you don't have question for budgets, though it's in the syllabus. So I'll just take you through the one which is here. This is a question actually. So the following information was computed by the Ministry of Finance for the year ended 2012. So budget and actual. So we have receipts and we have payments. So you can see the budgets, what they are budgeted to receive, and the actual receipts, what they are budgeted to pay, and the actual payments. Required budget outrun for the Ministry of Finance in accordance with IPSAS 24. Outrun is just the, after completion, you just tell us the budget actual variance. That's the budget outrun. So let's check the solution down there in the first page. The last page has 2 pages. So the first one, then we check the second one. So when answering that question in the exam, you copy again. So the question will be like that one, huh? So you copy again the budgets, the actual. Then your answer should now be the variance, which is overstock under. It can be overstock under estimation. For example, if I can pick first, under the receipts, receipts, under receipts, there was revenue from taxes. So revenue from taxes, they had budgeted with 18. They had budgeted, not we, they had budgeted to collect 18. Check like Nairobi County government, popularly known as Kanjo. They wanted to receive from tax 18. The actual they received 165. So they received less. So that is negative. So 18 minus 16, fine, 18 minus 16 is positive. But when you check in terms of receipts, that one becomes negative because they collected less than what they received, because maybe one of them was taken for a road trip. So hakufanya kazi. Then donations and grants, they were expecting to receive 24,000 from donations. They only received 18. So that is under negative. There's one I want. Kuna student wanakoseanga. Borrowing. Yes, check for me that borrowing. After other agencies borrowing. So borrowing from local, they had budgeted to borrow 120. They only borrowed 84,000. So that is also a negative, because some don't check it in terms of liability. Apana. Check in terms of revenue. Hata ukiwa venye nimesema wedding, your wedding umeona uwezi enter below 500. Then total receipt umepata for the wedding umepata 350. So that is a negative. The 150 is a negative variance because you will not meet your expectation. So don't check. Unajua kuna mtu anasema walikuwa wanataka kukopa 120 wakakopa 84. Sio ni mzuri. Wacha iwe positive. Hapana. They collected less. They were expecting to receive money from borrowing to finance their budget. So to finance their budget, they wanted 120. They only got 84. So that is a negative variance. There is revenue from trading activities, the last one, 72. They had planned to get 72. Then they got 90. That is a positive variance. So if you get more than what you had budgeted, that is positive. Let's go to payments. Let's go to payments. So payments, education. Education, they are planned for 180, only to collect 160. So this one is the opposite of that other one. They paid less. That is good. Pesa imebaki. So that's a positive variance. They had planned for 180, then they paid 16. That is better. I'm looking for negative. check housing, affordable housing. They are planned for 54. They paid 66. So they paid more. So that is a negative variance. So I hope that is something you people can do. One person can confirm. Joshua, is that something you can do in the exam, that comparison between the budget and actual? Brian? Maria, is that something which you can do? Let's say it comes that way, the way that one is. Yeah, that is workable. The way I know you people, Ibrahim, those are things which you can comfortably do. So you will answer it with Metro Mealika, then you do that. Then there is this second one. I cannot go without checking on it. It has an element which we have to check. But before I move to the last question, Joshua, but is that an affordable? What I don't know about affordable housing. You need housing too, the housing, see affordable. Now, in case the examiner tells you there was a supplementary budget, supplementary. So supplementary means is a budget you came up with after you had made your budget. It can be to reduce or to increase. So if you are told there is a supplementary budget, you add it to the budget column. Unatafuta that item kama ni taxation, unaongeza hapo. So supplementary budget, you add it to the original budgets. Thank you. Let's go to another question here, which is the last one. The following summary, I have a reason for doing that. The following summary of receipts and payment was extracted from the records of the Ministry of Finance for the fiscal year ended 30th June. So receipts and payments. So there was actual. There is the actual, original, and final. So you can get those three columns. So the reason why I'm checking this is because of those three columns in the budget. Answer is just one. Huko mwisho utaambia under stroke over. If you don't want the EU English, you're over or under, you just write variance. Examiner will not have any problem. So to answer it, you just be the under, over, or variance. The main issue is the three columns. How do we handle them? So we have actual, original, and final. So during comparison, get that with me now. During comparison, you only compare the actual and final budgets. You know what happens? Let me dispel this from your mind. People normally think ministries do make budget. They don't. Ministries, they just do what is called estimates. Then the estimates are forwarded to the National Treasury. National Treasury will come up with one consolidated budget. And that consolidated budget is what will be forwarded to the Parliament for adoption and approval. So what happens when the ministry makes an estimate, whatever they make will not be what will be presented to Parliament. The minister, the Cabinet Secretary for National Treasury, will go through that estimate and alteration will be made. Alteration can be up or down. Then they will consolidate with other ministries, then they forward. So the original, what they are calling here original budget, is what originated from that particular ministry. What they are calling final budget is the one which has been altered by the National Treasury and which went to the Parliament. So the funds which will be allocated from the Parliament, and now I'm talking from the perspective of receipts, or Parliament, what they do, they can approve that we have approved from tax, make sure we collect this amount. So the approval from Parliament will be based on the final budget, ikitoka Treasury. And now that is what you will adopt as a ministry. So for defense purposes, because there comes what we call AIE. AIE. AIE in public sector stands for Authority to Incur Expenditure. So you find that umeshatumia pesa yako mpaka imeisha, ama kuna surplus uko nayo na ufai kutumia, lazima upate authorization. So you can make authorization from the National Treasury, the authority to incur expenditure. Lakini utaulizwa, kwani budget yako kumeenda aje? So you will have that one obvious. The same, you look at my budget. This was my budget, but the money which I received based on this budget. So the original budget is for defense, mostly for defense purposes in case of anything. But when comparing, you compare final vis-a-vis the actual budget outcome. So in exam, just leave, you can write if you want, that actual, just copy it the way it is, leave it silent. Just leave it silent the way it is. Comparison will be based on final budget against the actual. So I hope that one you have understood, and you have understood very well. So I want to take, so go to the answer, the other page, how it is being answered. Lakini kuna moja bila hiyo student hapo nimewekea vizuri, mtajua ni gani. So check for example receipts. So huyo student there kuleta hiyo original kabisa hakutaka. You can fail to bring it, or you can bring it and make it silent. But why should you bring it here? Okay, hiyo silent in actual practice pale. Ndio watu wengine waseme, oh wewe sijui nini uliiba. But in exam weka final and actual. So the arrangement started with actual and final. So when comparing, you start with the budget. When you is when you go to actual. So imepangwa the other way around. So final, from taxation, they had planned to receive 1120. They only received 800. That is under. It should be negative. So examiners kudanganya students wamezoea wanatoka hivi wakienda hivi, wanasema 800 then 1120. So you must check where the arrangement, this is actual then final. So you move from this side coming back this side. So that's a negative budget because they received less. Borrowing, they had planned to borrow for 80. These people only borrowed 400. That is under, which is 80. Trading activities, they had planned for 840, they got 800. The same, that is negative. Basi ni gani walikosea? Labda huku kwa payments. Kuna moja huyu student alikosea. I want to check. Defense, check defense. Defense, the final budget, they were supposed to pay 720 for defense. They paid 800. That is negative. They paid more. Education, nil, they are the same. Let's go to housing. Here, Joshua. So they had budgeted for housing to pay 360. They paid 320. That is correct. They paid less, so that is okay. Then others, 760, they paid 800. Negative. Basi ni gani? Ama si ya huyu. Kuna mwingine nilionanga alikosea kitu ingine hapa. So my concern with this second question is those three columns. The actual, final, and the actual, original, and final. Don't use the original, use final against actual. So you can analyze that one at your free time. Also, I've given you the solution to this. So you have a lot of work. You really have a lot of work. So when we meet in our next class, that's what you do for me. When we meet in our next class, that is on Monday, God willing. On Monday, God willing. When the exam it is 4th December. 4th December is quite near. In fact, they will surprise you with the result before you go for Christmas. That one I'm sure. It is too near. Na hiyo time ni kama imeisha. It is over. So no problem. So when we meet on Monday, nataka kuwapeleka kwa shamba. Kwa shamba ni IAS number 41, agriculture. So I'll take you to agriculture. on Monday when we meet in the morning. So thank you so much, so much for your time. Actually, this class is really helping us to catch up properly with the syllabus, because hiyo siku tunafanya hiyo swali. Me of course siwezi fanya swali moja kwa topic, that's abomination. Tutafanya moja, then hiyo ingine tufanye on Friday. Then tukipatana hii Saturday yetu next week, huko kitu ingine huko. Probably tutakuwa tumeanza group accounting. Group is compulsory by the way. Tutaanza hii class when watu wakija wote. Maybe I can see a topic to kill that, but there is no topic to kill there. Those remaining topics are very sensitive. Very, very sensitive. But I see what to do. But I wanted to start group accounting immediately. It is compulsory in exam and see what to do. So thank you so much. Do have a good night and a nice weekend as we progress. We meet on Monday. You can log out.